In the world of Forex, one of the most overlooked aspects by beginner traders is transaction cost. However, this concept is crucial because it can make the difference between profitable trading and losses. Transaction cost is the price you pay to participate in the market. While it may seem insignificant at first glance, these costs, when accumulated over time, can significantly impact your overall results. In this video, we'll explore what transaction cost is, its components, and how you can reduce it to optimize your trades. Transaction costs in Forex primarily consist of three elements: spreads, commissions, and swaps. Each of these factors directly affects your profitability, and understanding them is essential. The spread is the difference between the bid price, the price at which you can sell, and the ask price, the price at which you can buy, of a currency pair. This is the most common cost in Forex and represents the broker's profit for facilitating the trade. For example, if the bid price of EU or USD is 1,1000 and the ask price is 1,1002, the spread is 2 pips. While this may seem small, when you make multiple trades, these small costs add up quickly. Spreads can be fixed or floating. Fixed spreads remain constant, while floating spreads vary depending on market volatility. During major economic events, floating spreads tend to widen, increasing your transaction costs. The second component is commissions. Some brokers charge a flat fee per trade in addition to the spread. This model is common in ECN accounts where spreads are generally lower but compensated by a per-lot commission. For instance, if you trade a standard lot and the broker charges a $5 commission, this amount is added to your total costs. This model can be advantageous for high-volume traders seeking competitive spreads. The third element is the swap, which is the interest paid or earned for holding a position overnight. In Forex, each currency has an associated interest rate, and the swap reflects the difference between the interest rates of the two currencies in a pair. If you buy a currency with a higher interest rate and sell one with a lower rate, you might earn positive interest. However, if the reverse is true, you'll pay a negative interest. Swaps are especially relevant for long-term traders, also known as swing traders. Now, how can you reduce your transaction costs? First, it's crucial to choose the right broker. Compare different brokers and evaluate their spreads, commissions, and swap rates. Also, consider the type of account they offer. If you're a high-frequency trader, opting for an account with low spreads and commissions may be more beneficial. On the other hand, if you trade occasionally, an account with slightly higher spreads but no commissions might suit you better. Another strategy is to trade during periods of lower volatility. During these times, floating spreads tend to be narrower, which reduces your costs. Additionally, focus on trading highly liquid currency pairs like EUR, USD, or USD, JPY, as they often have lower spreads due to their popularity. Lastly, planning your trades for the long term can help minimize costs. Traders who aim for significant market movements rather than small fluctuations make fewer trades, thus paying less in spreads and commissions. In conclusion, understanding and managing transaction costs is a fundamental part of any successful trading strategy. These costs, though small, accumulate over time and can significantly impact your results. Carefully evaluate your broker, use tools like liquidity and volatility analysis, and develop a disciplined approach to minimize these expenses. With the right strategy, you can optimize your trades and maximize your profits. If you enjoyed this video, don't forget to subscribe to our channel for more Forex and trading content. Leave us a like if you found this information helpful, share it with someone who might benefit, and let us know in the comments what topics or concepts you'd like us to cover in future videos.